Opendoor Technologies is currently trading at $5.01, following a sharp intraday drop of 5.83% during the most recent market session on Friday, May 8, 2026. The market is currently closed for the weekend, but the volatility we saw in that last session tells a massive story about where this company stands. Most investors looked at the headline and saw a top-line beat, with revenue hitting $720 million, which was actually higher than the $666 million consensus. But the reality that sent the stock tumbling was a net loss that more than doubled to $173 million. That is a massive gap between what the market hoped for and what the numbers actually showed on the bottom line. It creates a fascinating tension, because while the company is buying more homes than it has since 2022, it is still losing more on each of those transactions than the bulls were ready to admit. You might hear a lot of chatter on investing sites or through your individual brokerage newsfeed about how Opendoor is a high-growth play on the housing market recovery. The common ground most people stand on is the belief that if interest rates finally stabilize, a capital-intensive business like this will naturally flourish. But the deeper truth is that Opendoor is fighting a war against its own business model. While they've highlighted a 45% sequential increase in homes purchased, they are doing so in an environment where the spread between buying and selling is paper thin. This is the classic expectation versus reality trap. The expectation is that volume leads to profitability. The reality is that in a high interest rate environment, more volume can sometimes just mean more efficient ways to lose capital. When you look at the recent price movement, we are seeing a stock that has been a favorite for retail momentum. Over the last month, it actually moved up about 14% before this recent earnings hit. This is exactly where platforms like the Robinhood app or the Fidelity mobile app see massive surges in activity. Retail traders often jump in on the hope of a turnaround, but institutional activity shows a much more cautious stance. Morgan Stanley recently cut its view on the stock, and while Alliance Global has a price target of $8, the market is currently pricing it closer to $5 for a reason. There is a palpable sense of anxiety about the Q2 revenue guidance, which came in at $900 million, significantly lower than the $1.13 billion that analysts were banking on. This guidance miss is what really stung, because it suggests that the Opendoor 2.0 model isn't scaling as fast as the hype suggested. If you are using tools like Schwab Intelligent Portfolios or interactivebrokers trading platforms, you've likely noticed that the beta on this stock is incredibly high, sitting around 3.65. This means for every move the broader market makes, Opendoor is essentially on steroids. During the last week, even as the S&P 500 and Nasdaq were hitting record highs, Opendoor was struggling to keep its head above water after the earnings release. This divergence is a major red flag. Usually, in a risk-on environment where people are flocking to Nvidia stock or Apple stock, you'd expect a speculative play like Opendoor to ride that wave. Instead, it's being weighed down by its own internal metrics. The cost of carrying inventory is the silent killer here. Every day a house sits on their balance sheet, it's eating into their margins through interest and maintenance. Now, let's talk about the actual business for a second, because the business model is essentially being an iBuyer. They use AI-driven workflows and machine learning to give homeowners a cash offer, buy the house, do some light repairs, and then flip it. It sounds simple, but the execution is incredibly complex. In the past, companies like Zillow tried this and completely failed, exiting the space entirely. Opendoor stayed, and now they are trying to reach a goal of 6,000 home acquisitions per quarter by the end of 2026. This is their North Star. They believe that if they can hit that scale, the fixed costs of their technology and operations will finally be covered by the gross profit from the flips. However, in early 2026, we are seeing that even as acquisitions hit a multi-year high, the net profit is moving in the wrong direction. Institutional investors look at things like the price-to-sales ratio, and right now, Opendoor is trading at about 1.2x. If you compare that to the broader real estate sector, it looks cheap, but that is the expectation trap again. It looks cheap because the risks are massive. When you are self-investing or looking for investment help through a SoFi robo-advisor, you have to realize that Opendoor is more of a technology-enabled hedge fund for houses than it is a traditional real estate company. They are taking massive directional bets on home prices. If home prices in Phoenix or Atlanta drop by even 2% while they are holding 3,000 houses, that is a catastrophic hit to their equity. Comment below how many shares of Opendoor you currently hold, or if you think the iBuying model is fundamentally broken in a high-rate environment. The future outlook for the stock depends almost entirely on their path to being EBITDA profitable. Management is promising this will happen on a 12-month forward basis, but they've moved the goalposts before. The catalyst everyone is waiting for is a significant drop in mortgage rates, which would theoretically increase the velocity of the housing market. If more people are willing to sell, Opendoor gets more inventory at better prices. But the reality is that even if rates drop, competition from companies like OfferPad or even traditional brokerage models like Compass remains fierce. They are all fighting for the same limited pool of distressed or ready-to-move sellers.
Looking at the technicals, the $4.30 to $4.50 range has acted as a floor in the past. If the stock breaks below $5 and stays there, we could see a revisit to those lows very quickly. For those using the Fidelity trading platform or interactive brokers fees to manage active trades, the options volume has been skewed towards puts recently, suggesting that the smart money is hedging for further downside. The tension here is between the vision of a seamless, one-click home selling process and the reality of a capital-intensive, low-margin business that is sensitive to every sneeze from the Federal Reserve. When we analyze the sector momentum, real estate as a whole has been lagging behind tech. While everyone is focused on Tesla stock or searching for the best investing sites for the next big AI play, the boring old housing market is where the real macro pressure is being felt. Opendoor is at the epicenter of that. They have tried to diversify by offering things like Opendoor Mainstay and other service-based products to generate revenue without taking on house price risk, but those still make up a tiny fraction of their overall business. They are still a flipping company at heart. The bull case is that they are the last man standing in a massive industry, and that their technology gives them a data advantage no one else has. They argue that their AI can price a home more accurately than a local realtor. The bear case is that real estate is inherently local and messy, and an algorithm will never be able to account for the weird smell in the basement or the crack in the foundation that a human would spot. This is the fundamental clash of expectations. The market expects tech to solve everything, but the reality of real estate is often much more analog. As we look towards the rest of 2026, the key will be watching those acquisition numbers. If they can hit that 6,000 mark without the net loss expanding further, the market might finally start to believe in the turnaround. But right now, the credibility gap is wide. Investors have been burned before by disruptors that burn through cash faster than they built value. The contrast between the ambitious management commentary and the actual gap earnings miss is exactly why the stock is sitting where it is today. Authority in the market isn't granted through slick presentations. It's earned through consistent, profitable quarters. In summary, the expectation was a clear path towards a housing market rebound fueled by a top-line revenue beat. The reality was a widening net loss and lowered guidance that suggests the mountain is much steeper than originally thought. Opendoor remains one of the most polarizing stocks in the market, a true battleground for those who believe in the total digitization of real estate versus those who think it's a capital-heavy trap. Whether you are using Fidelity IRAs for long-term holds or the Robinhood stock trading app for quick plays, this is a stock that requires constant monitoring. The authority of the ibuyer narrative is being tested in real time, and so far the numbers are doing the talking. The next few months will determine if this $5 level is a bargain basement price or just a pit stop on the way back down to the lows. Opendoor has the technology, but whether they have the financial stamina to survive this cycle is the question that remains unanswered. Keep a close eye on the institutional flow, as that will be the first sign of any real shift in sentiment. For now, the reality of the losses is overshadowing the expectation of the growth.